All right, I had to get a cup of coffee. Peter Rose, Longwood Currency Trading. The other day I did a video on process-oriented trading, process-oriented analysis. I mean, I had a 33-year career as a senior software engineer doing internet-based business applications development. I spent 40 years as a real estate investor. I got a bachelor's in physics and, you know, all that stuff. That's my background. So I tend to look at the experiences that I've had and try to bring them to bear into my currency trading. I've been studying these markets since 2007 and actively trading them since 2012. Mini accounts and stuff, and lost money like everybody else, and then funded a big account in it's 2017 or 18, something like that. Successfully lost $40,000, and so kind of starting over from that. But in that journey, what I've come to learn in the currency markets that are different, for example, than real estate. I mean, real estate's trading is just a long-term trade. Talk about a long-term currency trade or a long-term stock trade. Try doing real estate and holding a building for 20 years. So I understand the trading process. I understand risk and reward and all that other stuff that goes into it. But there's tiny nuances in most of the other investment vehicles, including stocks and maybe even the commodity markets, that aren't directly applicable into the currency markets. And I think that's where the failing that I had came from. Trading the currency markets, as I've said many, many times, is simple. I made it complex because of my engineering background. That's what engineers do. They make things complicated. It's like somebody with a hammer. You're looking for a nail. In real estate, in physics and mathematics, all these things that I've done, computer programming, those are all complex things, and they require complex solutions. Now, it isn't that you can't use a methodology that solves complexity in a simple system. You just have to keep in mind that it's a simple system. You don't need the complexity. You're not trying to solve complexity. What you're trying to do is be organized in your approach. In a few of the videos that I've done, I've referred to PERT chart analysis that project management or project planning uses in order to identify the happy path and the least likely path or the most destructive path, and then you find out within those processes of trying to get from point A to point B, which one is the most likely. If you don't know what a PERT diagram is, it's just a bunch of boxes. You start out with a happy path diagram. Let's say we're going to move my office from location A to location B. What are the steps that I need to do in order to get there? What's the happy path that everything is going to go okay? Well, I got to pack up the current office. How long is that going to take? That's going to take a day. And then I got to load the trucks. How long is that going to take? Half a day. How long is it going to take me to get to the new office? That's going to be a half a day. And then unloading the office is another day. So I've got X number of days in the happy path routine. Well, what happens if the truck breaks down in going from point A to point B? That's another path. So you have to stop and fix the truck. But what does that have to do with the workers that were going to be at the other location to help you offload the truck into the new office? Well, that has to be rescheduled, so that's going to take some more time. So there's a new step to the plan. So basically what you're going to do in this PERT diagram is you're going to take all these different paths of all the different shit that can go wrong and how that's going to branch off and change the time. And then you have to look at that thing. So here's where nothing goes wrong, and here's where everything goes wrong. And somewhere in the middle is a probabilistic estimation of the best case scenario as to what could happen. Well, the truck won't break down, but We do have a construction thing on the road in the way, and so that could hold us up a little bit. So we'll take that path in there. So that's organizing. And you know, they use that same process whether you're moving an office or whether you're designing a space shuttle or something like that. So I use that not in a written form for my real estate development, for building software applications, and for doing creating a trading plan for currency trading. And so the other day I was talking about process-oriented trading or process-oriented analysis in the trading process, and I kind of got lost in the weeds about ranting about other things. It's July, by the way, of 2021 in New England, and the temperature over the previous night had been down in the 50s, and it had been raining and been cold. As I put my fleece shirt on, I started doing the video out on the porch. It was so hot. I had to stop the video and come in to take the fleece coat off and sit in the library and have a cup of coffee. I thought that was really funny that that I did that. Well, after I finished that video, I took my wife out we did a little bit of shopping, and we stopped off at one of the restaurants in town where they have an outside deck, and we sat on the outside deck and had a glass of wine and a nice dinner, and so that's the variability of New England weather. And why am I telling you this? Because it's a process. You know, I came into the day with a fleece coat because my process was it was cold during the night, it'd probably be cold during the day because it was cloudy. By the time I was out on the deck for 10 minutes, 15 minutes, it got so hot that I had a process of doing a video, and the rule was you know, wear a fleece coat because it'll probably be chilly out there. Well, there was a corollary to that rule. It said, you know, if it got too hot, take the jacket off. That is a process. So just sort of an aside as to, you know, put this into context of where this all goes in. And so I had a question from someone who said, well, you explained what the process is, but you didn't really explain how to do it. And what the ramifications were from doing it in a currency trading environment as opposed to you know, how you might do it in some other types of environments, such as the Forex market. A process-oriented approach to currency trading was defined as, well, what's the process? Well, a process is a series of things that you do to get from where you are to where you would like to get to, some end result. And so the end result of a currency trade is to have a successful trade that makes money. Now, I have to, let me qualify that, is to have a successful trade, a good trade. Good and bad trades, right? A bad trade is, even if it works out, if you did something stupid and it just worked out, that's a bad trade. A good trade is when you do the correct things, you take the correct steps, but it ends up in a loss. That doesn't make it a bad trade. It makes it a good trade that lost. So part of the analysis of any process, anything you want to do, has to take into consideration the likelihood of loss and the number of times that you may lose. And that's called, in poker playing or in currency trading or trading in general, that's called money management. And so the process-oriented trading is a process of managing the money for a probabilistic greatest expectation over a large sample size of trades. You can't just run through a minefield and get to the other side and say, I can get through a minefield. Do that 10 times. well, you're going to blow your ass up probably on the third or fourth time anyway, because you don't have a plan. And so a lot of these educators, and this is what I was railing about in my other video, most of the educators that you see out there have done 200 to 1 leverage. You get lucky, you do 10 really good trades in a row, and you take your little 4-figure account and you make it 6 figures or something, and that's possible in a 200 to 1 leverage and starting with $1,000 or $2,000. What's the likelihood that that's going to happen? Are you a fucking expert now that you're going to be able to teach other people? No. Well, let me ask you, you have to ask the traders that have made that money either through dumbass luck, or maybe they did know what to do, but they caught a couple of lucky breaks along. But regardless, if you're taking a small account and making it a big account in a short time, you do not know how to trade. You can take a small account and make it a little bit bigger account, but you're not going to take a big account and make it, you're not going to take a $30,000 account and run that to $1 million in 18 months. You're not. You might be, again, having excess leverage and then running those probabilistic 6 winners in a row, because you can have 6 losers in a row if you're trading consistently. And you could run that up. But does that mean you know how to trade? That's what they call the gladiator syndrome. You start with 100 gladiators, and you put them all in the thing, and there's 50 of them that are there's 50 of them that are left. So you put the 50 together, and they fight it out, and there's 25 left living. And you go all down the line, and you got one guy that lived. Now, was that guy just have a really lucky day, or did he win? If you look at the World Series of Poker, you have thousands of people coming in the United States. You have thousands of people qualifying for that or getting free seats or whatever that sit at the tables at the World Series of Poker. And very rarely now, with the thousands of people that are coming every year, do you get the same winner more than once. In the early days, when there was 20 people or 15 people that were competing, you get multiple winners because the guys were really fucking good. You had to really grind your way through. But once you get into the large numbers of players, you're going to end up with these morons that just have a lucky run. And when you're pushing all your chips in at the pot, that's a jump ball deal, right? I mean, you can have all the probability in the world that you think that your A-stuff pairs are gonna win out, and some other assholes got trip threes. But if you win, and you win $15 million or whatever it is you win, that doesn't necessarily mean that you're the best player. You got to do that again and again. There's stories about people who have won that World Series of Poker, won $12 million or $15 million, and then they get into heads-up play with guys that are really good, and they go to the wood. So look at the currency trading that we're trying to do. That's why I was emphasizing in that other video, you needed to have a process. Now, sure, a process is based on rules, but as I had mentioned in the video the other day, Richard Dennis said about his turtle program, I mean, he taught those guys for 2 weeks, and then let them trade a real account for a month, and the ones that followed the rules and did the best, they were given $500,000 or a couple $100,000. And one guy, Curtis Faith, got $2 million. He ended up making $30 million for Richard Dennis in the 5 years that the program ran. And the Turtles overall made Richard Dennis $175 million. So there is ample evidence that you can teach trading. Now, he had a set of rules that he had for the traders, but there's a quote that Richard Dennis says, I could give my rules away and no one would be able to follow them. No one would be able to duplicate that. And the reason for that is because the rules by themselves don't create the process of implementing those rules. That's what I went over in the video. So the comments that I'm getting or the questions I got, well, what are fucking rules and how do you do that? What's the process? Again, I have to emphasize that process is fluid and rules are not. So therefore, the only thing I can perhaps tell you is that it's the process that you need to learn how to do so that when you get to a certain point in the trading, whether that's a trade entry point where you need some rules, or you've got a trade management point where you're looking at, are you going to stage in, are you going to trail a stop? I mean, there's all those trade management decisions, as well as the money management decisions that you're running in parallel with an ongoing position. So at each one of those points, let's talk about staging in. You get to your stage in point, you might have a hard rule that says, well, I'm going to add a single lot at that point. You don't want a pyramid up. In other words, you don't want to start with one lot and add two and then add four. You want to start with four and add two and then add one. You got a reverse pyramid. Okay, that's fine. If you're doing it the other way, you're just going to lose your ass. But that's a rule. Pyramid going up, a pyramid going down, but don't pyramid going up. So let's say you get to a certain point where that's a point where you would add a lot, one lot. That's your process. Okay, add a lot at this point. That's called a process, and the rule is make it one lot. But the process says the reason that you're adding another lot is that the price appears that it still has the momentum necessary to continue on. You were needing to judge that momentum capability from a probabilistic standpoint when you were going into the trade entry process evaluation, yeah? And so you do that same evaluation here, and if price looks like it's running out of steam, are you going to add that other lot? Why would you? Because if you're adding lots every 10 pips and you add one right as price is starting to stall and it goes back, you've lost 10 pips on that lot, which takes away from the 20 pips that you made getting there. So now you've ended up with 10 pips on a, say, a 30 pip run, and how'd that work out for you? So you can't have hard and fast rules. That's why when I work with somebody, and you don't call me, I don't want to work with a lot of people because I don't have time for that. I'm retired, I'm having a good time, I don't want to be answering emails and stuff. And besides, if you're going to train with me, it's going to cost a lot of money. You get to pull me out of my deck chair. So train with somebody that isn't as expensive. But at that adding lot position, you have to do a reevaluation of your momentum analysis to see if it has the juice to go forward. If it has the juice to continue to go forward, you can add the lot. But what happens if the momentum is really taking off and that price just looks like it would be a really great entry point by itself? Well, why not add 2 lots or 3 lots or 4 lots? Because eventually when you get up to that next entry point, you're going to bring your stop up to break even on the 4 that you just added, so you're at no loss, and then you make another decision point up when you get up there. Okay, so that is rules which form the basis of a process, but the rules and the rules are static. The process is fluid, which means by having a static rule, you have to have multiple conditions for that rule in order not to get wrapped up. So now you begin to see complexity in your system, because now you're expanding exponentially the number of actual rules or corollaries of those rules as you're going through this process of putting the trade on. And that's what you want to eliminate. You want to eliminate complexity. That's where I think a lot of educators fail, is because they give you, as a trader that's trying to learn from them, so many options. You know, it's like walking into a hamburger place. I'd like a hamburger. Oh, okay. Do you want a bun with that? Do you want your bun toasted? Do you want both sides of the bun toasted? Do you want Angus beef or regular beef on that hamburger? Do you want onions? Do you want it ground up thin or ground up heavy? Do you want, I just want a fucking hamburger. So many educators, because they don't understand the teaching process, end up with all of these rules and all of these complications that just make you crazy. But that makes it very easy for them to say, well, there was a rule for that, you picked the wrong rule. Or you picked it at the wrong time. Well, what good is the education then? It isn't any good. It's called shotgun trading. Just because you're good at something doesn't mean that you're good at teaching it. I've spent 50 years, over 50 years in the martial arts now. I've trained hundreds and hundreds of people. And the whole basis of why I was good and why my students liked the training that they had, I've had students be with me 20 years, 30 years. I've still got students 45 years later that are with me. And it isn't because they need to learn an up block. It's because of the process, the simplicity of the process. Look, it's the process that's simple. If you have a process, you know where you're trying to get to. You know what the end result, and how many times have I talked about this and quoted or talked to you about the chess champion Jose Capablanca's last lectures about when he teaches chess. He goes to the end game. He goes to the teaching chess. Here's the two kings, and each one's got a couple of pawns and a bishop. Well, okay, let's take the bishop off and let's try to checkmate the king with a couple of knights. Okay, let's do it with a bishop and a knight. And you learn how to move the pieces and all that other stuff instead of sitting down with somebody, filling up the 64 squares with the initial things and saying, oh, I'm going to teach the Roy Lopez opening, you're going to respond with the King's Indian. Come on! How the hell do you learn how to play chess that way? And you can't learn how to do currency trading that way. And listen, I lost $40,000 because that's the way it's being taught. So nobody can argue with me about that. 90% of the traders lose 90% of their money in 90 days. And the reason for that is because of the people that are teaching you. There are some good ones, but 99% of them aren't any good because 90% of the people that are learning are failing. And the reason they're failing is because people may be good. There's some great traders out there, but they don't know how to teach. Doesn't make them bad people, but they shouldn't be selling. They shouldn't be selling courses. Oh man! If you're trying to do this stuff on your own, which you shouldn't do, you really need a mentor and somebody to guide you, because there's no way that anybody, as Richard Dennis says, of giving you the rules, the secret sauce rules, and having you be successful. I think the detraction is twofold in finding a mentor. Is number one, it's very difficult to find somebody who's not lying to you, and number two, do they really know how to teach? And is their concept of teaching you trend lines and support resistance and how to trade as prices bounce around off of support resistance lines? If that's the trade and you're paying a couple of $1,000s for that, you're wasting your fucking money because you can learn that in baby pips online. You know, if somebody starts and wants to learn to trade with me either through a course, I just finished writing a course, or I've written it 10 years ago, but just, you know, trying to put it together more for my own purposes of this process-oriented stuff that I'm telling you about. Anyway, regardless, whether somebody's taking a course from me or whether they want to sign up to have some mentoring or consulting, I want to know a little bit about that person, and I want to be sure that they have this basic framework of the mechanics and the plumbing of the process of trading down before they pay me money, because I don't want people spending hundreds and hundreds, if not thousands of dollars for me to teach them the difference between a limit and a market order, or what a head and shoulders pattern is and why you shouldn't use it. I just don't see any utility in that, because the traders that become good and become consistent have a process. And if you ask them to help you and they're not good educators, they'll only be able to provide you with rules. So you've got to figure out how to develop a process. Look, it's pretty simple. Look at where you want to get to. You want to get to a trade that ends up over many, many, many trades to be successful and to make money. You know, I've long said that if you can make 5 pips or 8 pips, I use 5 pips. If you could make consistently 5 pips 3 days a week, maybe you trade 5 days a week, maybe you trade 1 day a week, doesn't make any difference, but you make 5 pips 3 days a week. That's 15 pips a week, 60 pips a month. So if you're trading a mini, let's just look at a mini. You got $1,000 up front, you're trading a mini, each pip's worth $1, so you make it $60 a month on a $1,000 bank, and you're not compounding, you're just you're just trading $1,000. You make $60 a month. That's $600 a year with a couple of months off for shits and grins. That's 60%. Oh, okay, that's $600 on 1,000, right? Is $600 going to change your lifestyle? No. What are you going to do? Try to run the $1,000 to 100,000? No, 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 no. What you need to do is get consistent so that you can make 5 pips a day when you trade. Spread over the long run. You may lose 40 pips today. You may gain 20 pips tomorrow. You may lose 18 pips the next day. You may gain 40 pips the next day, and then you'll have a string of days where you gain 1 or 2 pips, and over the long run, over the average, you've averaged 5 pips, so you make the $600 for the year, you make 60%. How tough is it to make 5 pips? If you're trying to make 20 pips on a trade, you're out of your fucking mind. You have profit targets that are there. That's part of that process. What is the process that you're trying to do? You're trying to get across the goal line by running through many, many yards to carry the ball there, to get the ball there successfully. And you get 4 downs to make 10 yards. This is American football, right? You make the 10 yards, you get to put the ball, you get to start over again. If you're trying to hit 30 pips a day, you got to be taking 30 pip risks. If you're not a good trader, you're not able to spot your trade entries correctly, then you're going to lose 30 pips, 5 times? And you'll win 30 pips 3 times? You can't, because you're going to cut your winners short, right? And you're going to let some of those losers run. So until you get your win-loss ratio up by correctly identifying trade entry, you're never going to be able to get across the finish line correctly. That's the process that I'm talking about. How do you organize your trading into a process such that the rules that you have consistently help you get to that end goal for each position that you close out? And I just used the 5 pips as an example. Yeah, how tough is it to make 5 pips? It's tough to make 10 or 15 or 20, but how tough is it to make 5? It isn't that you trade put some trades on and make 5 pips and call it a day, because there'll be days where you're going to lose 15 pips or 20 pips, depending on where you put your stops. Now, I have some very specific rules. When I follow those rules, I do really, really good. But when I deviate from those rules a couple of times, as good as my win-loss ratio is, the 2 times that I would deviate from those rules can have catastrophic effect on my trading. It can take that account down 30% in a heartbeat. Oh, all I got to do is follow the rule. But the problem is that rule being correctly implemented in the correct location in the process that you have for the conditions at the time? That's where the mentor comes in. I didn't have a mentor when I started. I thought I could do this on my own. Process-oriented trading is what you should be studying, not what a pin bar pattern is. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.